Good afternoon from Fin Ratings. Ladies and gentlemen, my name is Ling Chen, currently Senior Credit Analyst, Investor Relations Officer at Fin Ratings. And we would like to welcome you all, ladies and gentlemen, joining us at this event. Since the start of this year, we have received many inquiries from foreign investors and local market experts. Now we think that maybe it's a good time to meet the strong interest from our audience. So we decided to answer it with our most updated data with a structured format so you can have an overall picture on the same page about Vietnam credit market. Under many uncertainties and important market events, the most asked question is which way to go and how can we do best to mitigate the inherent risks. So given the mission of Fin Ratings, we are here as an independent credit rating agency. So we are in the best position to provide you not just local insight, but with our data-driven analysis, we could provide you whether new information or a way to verify your view about the Vietnam local market. So we believe that on-the-ground data information will enable investor and market participants to confidently make decisions. So on the agenda today, our speaker will discuss the key trend in the credit market as of first half 2023 and how they weigh on our view as an independent credit rating agency. Please also be noted that you can later download the presentation deck via the email that will be later sent to your email. And we really thank you for strong interest and participation in this event. And thank many of you that have submitted pre-question, and our speaker today will try our best to address all of it and follow up on unanswered questions by email later. So today, sitting next to me is Mr. Quân Nguyen, Head of Fin Rating Institutional Rating. So Mr. Quân has 10 years experience in the financial sector in the US, and now he's joined Fin Rating as our team leader, my leader. So next to him is Mr. Khang Lê. He's now head of analytical rating at Fin Ratings. So Mr. Khang is a leader analyst for both financial institution and corporate rating. Mr. Khang has more than 10 years in auditing, investment banking in corporate finance. So last but not least, we have with me today, Mr. Hoàng Nguyen. Mr. Hoàng is a CFA charter holder and is now leader of corporate rating. He will share with you our analysis on not just the corporate market, but he also has some view on the security market because he has 7 years working as a credit analyst in a security firm. So shall we begin, gentlemen? So today, our presentation is divided into 4 parts. Firstly, we'll share our view about an overall picture about Vietnam credit market performance. Secondly, we will give some credit outlook from the view of a credit rating agency and specify some factors that could influence the creditworthiness of a company. And last but not least, we will have a Q&A session at the end. Moving to the first part about Vietnam credit market performance, I would like to ask Mr. Khang Lê. As we can see that Vietnam has finished the first half of 2023 with 4.1% GDP growth rate. With so many challenges for the second half to accomplish 6% growth KPI. So what was happening, and do you have any comment on the situation?
Thanks, Ling, for the question. It's challenging in my view, and a little bit of stretch for Vietnam to accomplish a whole years of more than 6% GDP growth, which means we have to have more than 8% growth in second half. So what we are seeing here probably all pointed to a rough path Vietnamese corporation has been experiencing in the last 12 months. The third in terms of GDP growth in second half of 2022, probably due to the impacts of low base effect. And we lost the momentum in first half of 2023. So more importantly, on the right-hand side, you can see that both import and export activities has continued trends of decreasing and even linger to post-pandemic. So even the trade balance still in surplus situations, creating cushion for State Bank Vietnam to provide stimulus package to support the economy, but we still believe it is even more concerning that G-Trend has so the decreasing, which demonstrate the lack of demand for manufacturing activities in Vietnam. So I suspect that we might be witnessing fragile consumer demands in coming periods. So move on to the next slide. We tend to observe credit growth movement across the capital market, equity market, and medium to long-term lending activities of commercial banks. And in our view, it's quite similar to the situations of GDP growth in first half of 2023. So kind of slow and lackluster. It's so a complete picture of deteriorated operating environment in Vietnam as of now. So it is the combinations of different obstacles that market participants are struggling with. For companies with good credit profiles, they switch to defensive positions and they tend to preserve their capitals. So the figures of capex investment for the first half of 2023 still hasn't come back to pre-COVID level. So that's the first point here. The banks, the commercial banks, they are reluctant to open access to companies with moderate credit profile because we believe that it is unnecessary for them to extend the loan book to riskier segment. So it is the situation here for the banking sector. And lastly, it is the weak consumer demands as people are worried about their interrupted incomes and the hostile interest rate environment.
So it's like a hard position for Vietnam economy. Then in your opinion, what should be the trigger for a way out? Or what kind of measure do you think could help to improve the situation?
I think the regulator has been quite active in the recent months, providing a stimulus package, supporting measures to the economy. But reflections has been quite modest and not reaching out to the mass. We believe if it can be catered to the needs of each sector, then it can be a more effective measure. Take a look at our real estate sector or housing sector. It is characterized as capital intensive, highly geared, and probably non-diversified sourcing incomes. So they highly depend on the progress of converting the land bank to finished goods. So for this sector, interest expense usually account for 5 to 7% of total investments for projects, which means cutting down on interest spend might not be their top priorities, but that rather depends on the progress of untying legal issues for their pending projects. So I think only then banks, home buyers, and developers might have a solid foundations to consume more capitals. And another example of aquaculture or an textile sector, they have been struggling recently, and we anticipate a significant squeeze in terms of profit margin for 2023. So they have been in a trend of deleveraging for like 5 years and quite stable in terms of borrowing over the equities. So they might not need borrowing more money, but cutting down on interest spend might be their top priorities. So that is the example of catering the stimulus package depends on the situations. So in my view, if that is do it the right ways, then credit growth will address the issue of each sector. Okay, so to the next slide, another observation here is Vietnam is banking-based economy, so it's quite unfortunate to see that corporate bonds in 2023 has plunged in terms of volume of transactions because we lack the sufficient infrastructure for capital market to operate efficiently to mobilize long-term funding. So if market confidence can be restored and having more fundamental or structural changes into the time to come, so it's possible to alleviate the pressure on the banking system. And for the default situation here, as you can see on the field of 5 in recent months, for the default case, with average maturity of around 3 years, we can imagine that these defaulted issuer might be into every possible scenarios during pandemic, post-pandemics. And the chance to recover in these periods are very low. So in our base case, we expect that for the end of this year, the default ratio might up to 40%. And I think that's alarming. And on one positive note here, you can see in figure 6, we have around 65% of defaulted issuer has reached mutual agreement with creditors to extend the payment schedule. So hopefully with that additional time, they can arrange funds or enhance the cash flow to pay back the principal.
So do you have any assessment on the specific issuers if other debt instruments of this year are being affected by worsening economic conditions, and what is the impact to banking system?
Yeah, you can see in the figure 8, it is our simple test, a stress test on the 3 different scenarios. So basically in the last 12 months, Commercial Bank has been actively reduced their exposure to corporate bonds as they respond to the negative development of the corporate bond market, and they switch to a more conservative approach. And they are even more cautious now to supporting or to refinance for the trouble issuer or issues for 2 main reasons. Stricter regulations has been promoted in order to prevent some of the activities previously implemented by Commercial Bank to support trouble issuer, such as refinancing or injecting more capitals in form of visit cooperation contracts. Secondly, according to Circular 02 promulgated in 2023, commercial banks are now able to making provisions without reclassifying their bad debts into non-performing loans category. So you can imagine that non-performing ratios would not be severely impacted. So do not impact the operation of the bank in general. So the bank are less motivated to having more exposed to a trouble issuer. So they tend to leave it there and waiting for the time to come and might do the liquidations if necessary. So that's the 2 observation here. For the base case scenarios, we have itemized quite amount of defaulted issuer. The situation here is a significant amount of resources are stuck in unfinished project in the form of corporate bonds or bank loans. And if the situation is unwind, it is likely that the bank loans are going to be non-performing next. So in our base case, we expect that the NPL ratio of the banks might be added 1.4% more, and for the worst case, it can be more than 3% more. So although the policy forbearance here do not deliver market disciplines, but we believe it perhaps enable repayments. And according to our observations, the risk absorption capacity of commercial banking system now much better 10 years ago, because the NIMs is much better than regional peers or international standards. So we strongly believe that the banking system still have buffer and they are well equipped to handle the case of rising bad debts.
So, Mr. Khang, do you think that among all the downside risks you just have mentioned, are we going to bottom out this year, and what are the key watching factors?
The timeline we expect that it is at least 12 months from now for the market to bottom out, or even a little bit longer, because of 12 months or even like 18 months, because following reasons that the importing export outlook still subdued, and consumer demands are kind of fragile. They are worried about the labor market and their interrupted incomes, and also legal complications regarding to the land laws, and also the detailed guidance regarding to PDPA, Power Development Plan 8, and also the pressure on the exchange rates might arise in coming periods when Fed keep hiking their rates. So those are the headwinds that we expect to be happen in the coming periods. So beside those stated headwinds, we expect following factors could help the government to achieve 6% GDP growth for 2023. It would be continuation of easing monetary policies and the accelerations of infrastructure investment, and also the guidance on PDPA, or further is the amendments of land law in 2024. So that would be those watching factors we follow up in order to reflect to our credit rating actions.
So on the next topic, we will move to sector credit outlook. As you can see, FP Rating will release a numbers of credit rating report. However, the work behind it is much more than the number that we release, which means that we have to do preliminary ratings for roughly 300, 400 companies, so that we can have a comparison view between the company and have a overall picture of where the company would fit in the overall credit market of Vietnam. So now I will give the mic to Mr. Huang to deliver the second part on the credit outlook under CRA perspective.
Thank you, Ling. So we all know that different industry, they differ significantly in their characteristic and potential for growth, but along with this, also their inherent risk. And at Fin Ratings, we believe that understanding those risks is crucial for investor and for business to make informed decision and implement a appropriate risk management strategy. So to illustrate this better, you can look at the figure on the right. We have ranked those 13 sectors in terms of risk. If you look at the number one, in our view, we assess that regulated utilities, and specifically the traditional power generation, which includes hydropower, coal-fired, and gas-fired at lowest risk. And going down, we have residential real estate at moderately high risk, and with trading, especially commodity trading, we believe it is a very risky sector. So to elaborate more, let's take an example of the traditional power generation. You may know that the price mechanism for those companies in this sector is strictly regulated and often in a cost-plus scheme, so it can ensure a certain profitability or profit margin. Along with that, the event often set a contracted quantity, so in terms of demand, it is relatively stable. Thus, known quantity and known profitability, along with a high barrier to entry, creates a relatively low-risk sector. On the other hand, if you look at the residential real estate sector, the cyclicality of this sector has been observed at a very high level during the last 10 years or 15 years. During the downturn in 2008 or until 2013, the last global financial crisis, we have assessed the volume and the operating performance of real estate developers in Vietnam, and we estimate that they experience a decrease of 41% decline in revenue on average, and a drop of 20 to 23% in EBITDA margin. That's a huge figure. So based on that, you can see that our preliminary credit ratings estimates of more than 300 companies in different sectors in the figure on the left. We note that it is not the final credit rating, but it's just our preliminary credit estimates based on the public information only. And you can see from the chart that most of the companies on the study falls in the range of BB to BBB category, reflecting that the credit rating score for those companies is at average level. In the next slide, I'll talk about the more specifically about the sector credit outlook on overall and go into details further. So this is the outlook in the next 12 to 18 months of specific sector. In this slide, you can see our assessment of the outlook is within a 5 scale range, ranging from positive to negative. And you can see from the color of the chart that we believe that the economy is bottoming out, but the recovery is relatively slow, and I mean at a modest pace, and it might take a longer time. So in number 1 and number 2, you can see regulated utilities and industrial real estate. We expect that those sectors will have a stable and positive outlook as the demand supply dynamics in those sectors are in a favorable shape. The government has set out a long-term plan as well as the accelerated infrastructure, like I can mention, will help support the growth for those sectors in the long term. On the other hand, if you look at number 3, 4, 5, we believe that residential real estate and other related sector like construction or construction material or mining is still at a negative and deteriorating outlook. The main reason for this would like to be in the regulation and the legal bottlenecks that we believe that very unlikely to resolve in the short term. And we might have to wait until the revised land law or housing law is approved in the end of this year or beginning of next year. And we'll go into details in a later slide, and that's basically our view on the corporate sector. And before moving on the detailed analysis of those sectors, we also got the diverse outlook opinion on different subsector of financial institution as well. And for this matter, I think Mr. Quinn can help me to elaborate.
Sure. Thank you, Hoàng. So as you said, there's a divergent outlook opinion on the 3 subsectors within the financial sector that we are watching. So I'll start from the not so good one first, which is the non-bank finance securities. We expect the outlook for this subsector is deteriorating outlook, but not to the negative level yet, due to the asset quality deterioration after COVID, further worsened by recent investigation by authorities regarding debt collection measures. Also, the borrowing demand has decreased due to weakened economy, and now the finance companies are hesitant to lend out to new clients due to the worrying but due to the worry that that might become bad debt. So the key drivers for this subsector to recover, in my opinion, would be the further legal framework development for the business and operation of the MBFC, especially for debt collection measure. That and alongside with the economy recovery, which Mr. Kang has mentioned, will be the main driver for the sector in the next 12 to 18 months. Next, we got banks, commercial banks. See, the drivers for the commercial bank here is a possible further deterioration of asset quality in the future, which I will talk about in detail in a bit, which is partially offset or alleviated by the supporting policy from the government, which the effect will have to assess in the upcoming time for the how effective those policies are. But however, we still believe that the commercial banks are still in control of the situation, and depends on their lending decision. The appropriate lending we believe will ensure recovery and sustainable growth for the sector, which is why we leave the outlook at stable. And for the good one, the securities companies, we believe the outlook here is improving from last year, thanks to the strengthening funding and earning profile of the securities company, which the market improvement plays a crucial role in the outlook change. I also touch on this a little bit more, but the key driver here for this sector would be for large securities company, you want to look at how they're managing their risk, so their risk management. And for smaller company, you would want to look at their risk appetite, because from our opinion, the main drivers for the securities company in the next 12 to 18 months would be on margin lendings and investment activities. So that's our view from the financial sector.
So now should we move to the next part into more details about sector analysis? Should we begin with residential estate, Mr. Hua?
Surely, I think residential real estate is the sector that we have received the most question in the last 1 or 2 years, due to all the market conditions happening. So we hope to provide you with the most updated data. And if you look at this chart, this shows the new supply and the transaction in the last 5 years. And as you can see from the chart, from the Q4 of 2022 until now, the new supply is very limited. And although the new supply is very limited, the absorption rate is less than 20%. So we can say that new sale almost disappear in the last in the last 6 months. So that leaves the real estate developers with almost no new operating income. And we believe that this situation will prolong until the legal bottlenecks, as Kang has mentioned, the new land law, the new housing law is approved in the next year. So in this context, we believe that developers with sufficient cash buffer can withstand this market downturn. If you look at the chart on the right, we have estimated the liquid asset or the liquidity pressure to the real estate developer in the next 12 months. And a majority of real estate developers will have I would say, a liquidity challenge in the upcoming time. And along with that, the legal bottleneck is not likely to resolve soon. So we believe the negotiation of the debt coming due will continue to happen, especially when the bond maturity is coming due in Q4 of 2023 and the first quarter of 2024. In short, we expect the restructuring process and the delay in financial obligation repayments will continue at least in the second half of 2023. On the other hand, we have the industrial real estate. We believe this sector will have a more stable outlook. The overall picture is better. You can see from this chart, this show the FDI disbursement in the last several years. And although it has slowed down in the first half of 2023, it is relatively stable in comparison to the residential real estate one, right? And it can be shown in the absorption rate of more than 80%. So it is significantly diverged from the residential real estate where the sales almost disappear.
Yeah. So to add more comments, industrial real estate outlook, we still believe that the outlook is much more stable than housing market, because according to our observation for industrial real estate developer, we still see a lot of MNC or conglomerates, large corporations. They are trying to reallocating their manufacturing chains to Vietnam or looking for opportunities to investing in Vietnam. So it is worth noting that at the current moment, industrial real estate developer who own the pipelines, which is ready for the development or remain intact, will be placed at favorable conditions. So therefore, we believe that there will be companies with a good position and much better credit quality compared to the average of the industries.
Thank you, Inka. So in short, we believe industrial real estate will have a more stable outlook than the residential one, right?
Right.
Yeah, and moving on to another sector that a lot of the audience and the investor are asking questions. This is the energy sector. So as you may know, the long-awaited Power Development Plan 8 or the PDP8 has officially approved in May. So we believe this is really a positive development for the whole market because it sets out a clearer path toward a sustainable development of Vietnam. But noticeably, although green energy is a very important part of this plan, we expect renewable energy developers right now might face some challenge. You can see in the chart on the right, we estimate that almost 40% of the wind power energy developer having the debt over EBITDA of more than 8 times. And along with that, if the tenor of their debt is like less than 8 years or even 10 years, we think that they might have some challenge in the upcoming time. And with the new selling price of the transitional project of reduced by 20%, the problem or the challenges is even more. On the bright side, we expect more guidance from the government will be set out soon. For example, the pricing mechanism for the upcoming, the totally new projects, or the actual execution and arrangement between among financiers, or etc. But overall, we believe that even with the lower tariff, the prominent developers with the proven track record can negotiate with their contractors to be like economically viable. And I think that's a good thing for a more sustainable Vietnam. In the next slide, this is about commercial banks. So I pass the mic to Mr. Quinn.
Thank you, Hoàng. Okay, so in this slide, I will speak on our view for the banking sector outlook, specifically on the outlook key driver, which is asset quality. So as you see here on the top graph, it shows the adjusted NPL, which we include the reported NPL, which is the yellow bar, and the VIMC bonds, which is the red bar of the sector, as well as the loan loss reserve coverage for the adjusted NPL, which is the yellow line there. As you can see, the rise of NPL in the last 2 quarters is an expected outcome from recent capital market headwinds with the real estate market downturn and corporate bond defaults. Now, when you look at the bottom graph, it's pretty much just a top graph adding with the special mention loan, which is the group 2 in the loan categorized, which is the blue bar at the bottoms, as well as the loan loss reserve coverage recalculated to include the special mention loan in the denominator. We believe that the significant increase of special mention loan in the last 1.5 years, as you can see, is noteworthy and will no doubt add on to the considerable asset quality pressure that the sector will face in the next 12 months. Now, I would like to make one observation here. You can see in the bottom graph, if you look at the sector from 2021 until now, it looks quite similar to the sector situation from 2012 to 2015 in the top graph, which which sharing certain characteristic, which is asset quality facing certain pressure, real estate market downturn, and government intervening with policy assistance. Now, if that's true, there are two scenarios here. One, either we are at the same point as we were in 2014, which means that by the end of next year, 2024, the asset quality figures will reflect at their worst, which means the figures will be at their worst, reflecting what the sector will go through in the next 12 to 18 months, similar to what we experienced in 2015. Or the second scenario here is that, which is the more positive scenario here, is that the policy intervention by the government was timely and helped fasten the recovery process. If that's the case, by the end of this year, 2023, the figures will already be at their worst, which was similar to the situation in 2015. And by next year, things will start to recover. It will get better, not much better. It will get better. Personally, we hope for the second scenario, which is more positive, but do keep in mind that these graphs do not yet include the restructure loan, which is in group 1. So if majority of the restructure loan become non-performing, this first scenario, which is the more negative one, will be more possible. Now, however, as mentioned previously, we still view that the outlook of the banking sector is relatively stable in comparison to other industry, thanks to the policy support that will help alleviate the asset quality pressure that the commercial bank will face in the upcoming time. In addition, the impact of real estate market downturn and corporate bond defaults vary across different banks, which means not all the banks are hit similarly due to different level of exposure. In the medium to longer terms, appropriate lending to companies with good business position will ensure faster recovery for the bank's clients and help drive a commercial bank's sustainable growth. Now, let me move on to the securities companies. So there are two main points here that I want to touch on. The first one is the funding profile of the securities company. As you can see in the top graph, securities companies in recent years have been relying on two primary sources, which are equity and short-term bank loans. Long-term bank loans portion is very insignificant. We expect that the funding from bank loans will increase in the future as their borrowing needs from securities companies to fund for the increasing margin lending activities in the upcoming few quarters after all the interest rate cuts by the government. There are also lending needs from banks. Through most of the banks will be in relatively short terms. This will no doubt raise the gearing level of the sector. Now, one may think that this is bad. However, from our studies, top securities companies in Vietnam are less leveraged in comparison to some top securities companies in other countries like India or China, which their average is about leverage level is about 3 times, while having similar business model as them. So this projected increase in gearing level will not necessarily have negative impact on the securities company's creditworthiness. On the contrary, an increase in margin lending activities may have a positive impact on the market liquidity and index, which will help the sector strengthening its earning profile, which was not so great last year. Now, the second point is regarding the earning profile. If you look at the bottom graph, the sector investment yield has shown noticeable recovery from last year of 4% to around 7% of this year. And the first half, 2023 is trailing 12 months. So you can see the clear recovery there. Although the market may be a bit bumpy in the next few months, we expect that this improving earning trend will continue for the sector for the rest of 2023, with the key drivers being investment and margin lending activities. Now, we don't expect the recovery to be at the high year yet, but it will be at maybe 2018, 2019 level. The watching factors for this sector, in our opinion, will remain the activities associated with the corporate bonds market. So these activities will affect the securities company liquidity positions. So those will be the watching factors from outside. So with that, I'm gonna pass it back to Ling.
A very long and insightful presentation. So maybe this is a follow-up question, but I would like Mr. Khan, Mr. Huang to briefly summarize the key watching factor for residential real estate, industrial real estate, and energy.
So I think for residential real estate, we'll have to wait for the new law. And after that, we'll start to have the investor and home buyers confidence back. And I think that might take a long time. Along with that, another watching factor is all the restructuring and the M&A activities on the market, and also the conditions of the financial market too. Because if all the credit tightening is happening, there is no way for real estate developers to refinance. So that's for the residential real estate sector. For industrial real estate and energy, we believe the long-term plan is already set out, and that's a positive signal. But more guidance on how to execute those plans will need to be monitored. So that's my opinion.
Thank you. So before going into details for the third part about the company-specific factors, I would explain for the audience about our rating scale and why it matters. So as you can see, this is a kind of differentiation between domestic rating scale and global rating scale. The main idea here is with that with the domestic rating scale, we can have a wider credit differentiation. So why so? The global rating scale is capped at the sovereign rating. So as you can see, the S&P Global Rating, we are capped at Vietnam BB+, and for Moody's, we are capped at Ba2. So if you are an investor or foreign investor who want to explore the credit market in Vietnam, so it's kind of difficult to differentiate between investment grade company and sub-investment company. So at Fin Ratings, we do a surveillance every 6 months. So with our local insight, we can update to you not just on the ground market information, but also you can have a very much differentiation when it comes to your asset allocation. So this slide, so what is the approach to assess and how to monitor credit quality of a company? I will pass this back to Mr. Huang Yuan.
Thank you, Ling. I think the question is really interesting, that how do we monitor the credit quality of a company, right? But before answering the question, I would like to present what we have done in the last 2.5 years. So this is the rating actions by Fin Ratings for more than 20 issuers in 8 different sectors, and the credit rating range from like A to B category. So you can see, as Ling has mentioned, the wider credit differentiation in comparison to the global perspective. And until now, we have many more issuer on surveillance process, and you can visit our website for the public announcement of those rating actions. And now back to the question of like, how do we monitor the credit quality, or I would say how to navigate the uncertainties, like the title of the event, right? So this is our observation and perspective in the last rating actions that we have conducted. So we believe there are three main key things that we need to consider. Number one, this is, you can read from the slide, scale does matter, but efficiency is more important for sustainable growth. And for this, I would like to demonstrate a story of a quick growth real estate developers. So the red line is the debt amount of this developer, and it has grown significantly in the last 6 months, 6 years. The annual average growth is 30% every year. But on the other hand, the net income is only growth by 6% annually. So when the financial market conditions worsening, suddenly the refinancing or the capital raising capability is vulnerable, and I think the chance to refinance or the challenge to this company is at dangerous level.
Okay, so adding to the comments of Huang, I believe these are a common trait of a research sector. So as you could see, the distribution of rating for this sector is around BB category, which means speculative category, I believe. So not till now, 2022 or 2023, we have the rating fall into those categories, but you can see back to 2019, 2018, they have shown sign of, aggressively employed gearings. So in a continuous level. So we believe somehow it will be reflected to the credit ratings of the issuers. So the whole true for real estate sector.
Thank you, Inka. So that's number one. Number two, we believe the asset and liabilities duration mismatch can result in a liquidity challenge, even though you have a very good business that is profitably in the long term, but this factor is worth watching. So by that, we want to illustrate by a debt schedule and the EBITDA of a renewable energy developers. You can see from the chart that this is the debt schedule. So basically the money out and the money in for the company. We have conducted credit rating for some of the top 10 renewable energies, and I think this is a very common story for the developers. In short term, the debt servicing capacity is I would say insufficient. But in longer term, if you can survive those first 3 years, we become a very attractive and profitable company.
Yeah.
And do you want to add something to that?
So I believe there's a thing about structural changes. I mentioned previously about the capital market. So for this time industry, which is capital intensive, we see that they might have a prolonged period of payback. So companies will need a lot of long-term fundings to finance for these kind of projects. Let's say 10 or 15 years. And in Vietnam, it is mostly bank will taking care of these demands, but it's not enough. So I think the situation is very risky, but it also showing opportunities for investor. If they can arrange long-term fundings, then you can see that these projects still yielding stable cash flow for very long horizons. Long horizons. So.
Yep. So long-term assets should match with long-term funding. Right?
Yeah.
Okay. So that's story number two. And number three, we'll have the observation that it is necessary to have a buffer, especially when the uncertainty arises, right, in this context. So by that, we compare two real estate developers, one with investment grade credit rating and one with sub-investment grade credit rating. The one on the left always maintain the liquid asset a percentage over their total asset of 20 or 25%, and the one on the right hold like zero cash or very limited liquid asset. So in normal condition, you can see that the one on the right got like significant growth, but when the uncertainty arises in 2022, the one on the left still maintains stable, but the one on the right like wipe out all of their equity.
Very bumpy.
Yeah, so it is very bumpy, and I think the balance between the return and the risk is a crucial decision for business owner, and we believe the key is not to predict the future but to prepare for it.
Yeah.
Right.
So I think this is also very true for the financial institutions. From our study of this Chess's case, when things go south, many things go bad at the same time, right?
Mhm.
Because financial markets still operate significantly based on confidence. For example, like when there's a negative rumor on a securities company investment, it does not only affect that investment or that activities, people start asking questions. Hey, what is that company doing? What is that company investing? What are the related companies are doing? And people will start to withdraw fund, withdraw deposit, closing accounts, and so on, which affects, the company funding and liquidity position also. So in the case of a securities company that runs into similar problems, the investment grade, in a specific case that we handle, that investment grade company thankfully was having a decent cash buffer and allocate a significant portion of its asset on liquid asset, which are then utilized to help them operate during stress time. Now, as CRA, we understand that company likes to utilize their fund to the maximum to achieve, highest efficiency. But from our view, having a decent buffer, while not, the most efficient thing, is still crucial in supporting liquidity in tough times.
Yeah.
And that's what makes a company's investment grade or non-investment grade.
True.
Just a follow-up question from my side, for Mr. Huang. For the speculative issuer on figure 22, how could they keep little cash on their side? How could they operate?
So basically, you're asking about the sub-investment real estate developer on the chart, the figure 24, right?
Yeah.
So they reinvest all of their profit in new projects, and they keep very little cash. So we can say that they go all in, and then the financial market and the real estate market go downturn. It went badly for them.
Another question for Mr. Kang Lei. So after all this number and all the analysis, so why do all this matter? Why the investor should care about it?
Thanks, Link, for the questions. I think the market, the Vietnamese corporate bond, for example, has passing the point of booming in terms of volume, but it dive deep into the development of infrastructure framework investment tool, where people recognize even more the importance of credit risks that they are facing, instead of being driven by interest rate offering or term and conditions, those covenants or the value of collaterals. So it's not going to support them significantly in terms when things go south, like Quan and Hoàng just shared. So we believe in the future, next 1 or 2 years, hopefully we can having an interest rate curve. For example, here is the situation of a real estate developer that, according to our observations, that quite differentiations in terms of interest expense they have to endure, depends on the category they are in. So hopefully in the future, all the risks and all the opportunities will be discounted and reflected into the interest curve. That would be a good reference for investor.
So in your opinion, if you have already the government initiative to run a public moment trading platform, so it will be also a supportive argument for the curve, for the yield curve, to form maybe this year,
Later years.
Later years.
Yeah, in a time frame of 24 months. I think.
Okay, thank you. So now, ladies and gentlemen, we may pass to Q&A session. So we are very open for any questions. So you can have a chat box and you can type your question into that, and we would like to address this later. We also receive a pre-submitted question from our platform. So I would like to pick some to ask the three speakers here. Mr. Kale again. What is your views on the credit demand toward end of the year, 2023? Currently, credit demand is very weak. So what policy should be used to support economic growth?
I think the demand will be maintained at a moderate level toward the end of this year. So like I say, it needs to be catered to the needs of each sector. Depends on the situations they are in. So maybe, for example, real estate sector, if any accelerations in terms of untidy bottlenecks regarding to legal issues, for example, defining the pricing mechanisms to support real estate developer to fulfill their financial obligations. So they're getting the approval in terms of investment license or construction permits, which is a watching factor I mentioned previously for renewable energies. We believe if we have a specific guidance on pricing mechanism, then banks, creditors would have a very good foundations to solve the mismatch in terms of asset and funding matchings. And for other manufacturing sector like textile, garments, or agriculture, it has to be the cutting down on interest rate. So the demands for capitals might not be real high, but it gradually recover. Hopefully for 2024, early of 2024.
Early 2020.
Yeah.
I received also a question for financial sector. I would like to address to Mr. Kwon about consumer finance companies. So consumer finance companies have been in trouble for a while with decreasing asset quality, worsened earnings. So why is Fin Ratings maintaining the industry anchor or risk assessment at investment grade level? So do you foresee any recovery in the time to come?
Okay. So this is a big question. I'll answer in a couple of parts. So for our industry risk assessment method, the industry is assessed based on several factors that we believe that have long-lasting impacts on the credit worthiness of the sector, such as barrier of entry, regulations, capital intensity. So in comparison to other financial sector, the consumer finance sector is still a bit less regulated in comparison to securities company or commercial banks, and their funding profile is more limited. That's why they I guess their anchor or the industry risk assessment level is lower in comparison to other financial subsector that we cover. However, for the consumer finance company, even though the asset quality and earning deterioration are existing, we have said that many of the main industry factor, like I mentioned previously, would still remain the same as few years ago. So the essence of the sector still didn't change, basically. So we also expect that regulation will be tightened up, especially for debt collection measure. And additionally, similar to banks, the impacts vary between the finance companies. So the companies with strong capital base, strong funding ability can still get past the challenges, in our opinion. Not to mention that in longer term, consumer finance market is still very promising, with the proportion of unbanked and underbanked population is still remain very large. That being said, we still assess that the industry have very strong ties to the economy. And as Mr. Kang has mentioned before, Vietnam economy would be in the recovery mode in the next 12 to 18 months. So that would affect the main client base of the finance companies, who are workers or small households, businesses, and others with relatively lower income. So while we will see certain recovery in the sector, it will take some time to get back to the pre-COVID level. By our estimation, it will be somewhere in 2025.
2025. Thank you, Mr. Kwon. A question for Mr. Huang on Novaland. Novaland bond issues update and credit rating on top 10 real estate companies and top 10 main construction contractor in Vietnam. You want to take it?
Yep. So Novaland bond issues update, right? So firstly, we have not conducted the credit rating, the solicited rating with Novaland. So all of our information is public information only. And from what we had gathered from the public source, the Novaland bond issues update is still in restructuring process. They have announced the delay payment in the latest bond in, I think, the last week. And I think the restructuring process for them is still happening. But yesterday, we have the news that their projects in Dong City is approved to continue to construct and to sell to home buyers. So I think that's a positive development of Novaland operating performance. So that's all the information for Novaland issues update. For the top 10 real estate companies, I think the question is for residential real estate companies only. You can look at the preliminary assessment of our work. And if you look at the color green, most of residential real estate will fall in BBB or BB category. And so you can imagine I think even the top 10 residential real estate company in Vietnam will fall in BBB category. Because inherently real estate is a risky sector. The cyclicality and all the volatility is much higher than other sector.
Yeah, I think a little bit of insight here regarding to the rating distribution of real estate and construction companies. I think I kind of align and link to each other. So the usually performance of construction companies, we are linked to performance of housing markets. And however, still there are huge differentiations in terms of technical capacity and cost controlling vary across issuer. So for the subsector, it depends on the subsector they are operating within. Let's say are building a manufacturing hub for lower MNC, which require strict conditions and very demanding. So the construction company might have better, have to be better credit quality and better buffer in terms of financial positions. So they can be selected by those MNC. So they usually very demanding. So recently we published a rating of Cotecom City, so BBB, which means investment grade companies. So we published the details, and we believe they have a good risk management in place and good liquidity positions. to withstand the impacts, negative impacts of housing market.
So if I have to summarize, like one word for Novaland, it would be like soft landing.
Those soft landings we've been observed in 2022, right? Or for some case, the issuer they have interrupted cash flows because of low mobilizations during a time of COVID-19. They active in food and beverage industry. So right after it is recover, the situation is much better for them. So they pay back all the debts and recover, let's say 100%, reaching pre-COVID-19 level. So I think a scenario of soft landing for Novaland is possible.
Thank you, Mr. Kang and Hua. Another question. Can we have FinRatings' view on improvement of real estate corporate bond issue in this year and 2024 as part of looking at high frequency data, both macro and sector specific? It might be related to the last question.
My view is that it will not be finished the process of bottoming out within this year, because I just said previously that due to the policy forbearance, many developers they are still looking for the way out instead of using the liquidations options. So and also the observation is there will be not a massive cut down in price on the outputs, because it can affecting the collateral valuations, affecting banks, the developers, and even home buyers. So we don't see that scenario to happen within this year, but rather in 2024 when the extension is passed. So they might seeking other options such as M&A. So that's the reason why we believe the default rate could be up to 40% within this year.
Thank you, Mr. Kang. Shall we move to another sector, commercial banks? Do you have any observation on credit trends of commercial banks, Mr. Kwon Yuen?
Yes, so if we can pull up one of the slides that we have prepared, which is on the sorry. So this one maybe after. Oh, there you go. So this is a slide. This is a page in our banking report for last year. So as you can see in the top graph, there is a that is the standalone credit profile of the commercial banks, and in the bottom graph is which standalone profile, which means that is we don't factor in any external support from the government or corporate or the corporation yet, parents corporation yet. And in the second graph is the ICR distribution, which we did factor in the quality of the external support from the government. So as you can see here, I think this reason why we still also part of the reason why that we expect the outlook stable for the commercial bank, because we do see a migration from to the lower credit quality for the commercial bank in the past 2 years, which I think is a bit concerning. But there is also an increase in credit quality in certain banks also. So we say this every year, but there is a diversion in the bank's credit profile. And we expect this to continue even further this year, because like we said, different banks have different level of exposure and impact by what's been happening in the year and a half. So So we do expect the credit quality will be changing, will be migrating for 2023 as well. So, and we, even though we haven't rated any officially rated any commercial bank, but we have done some work for the for many of the investors by monitoring the sector and watching the credit quality of the banks.
And
So
regulator.
yeah, so there's that. And if there's any follow-up or further inquiries on that, I'll be happy to answer that as well.
So just want to remind that our analysts, Mr. Kwon, Hoàng, and Khang are very open for questions. So we would like to receive as many questions as possible from our side, and we try to get back to you by email later, or if we have time, we would like to address this verbally right here. Another question for Mr. Kwon on the stock market.
Oh, okay.
In the scenario where stock market recovers and improve, would that mean that all the securities company credit rating would go up?
That is, I can say it for sure. I think that's partially true. So when you address, because we do assess both because a lot of the nature of the business, right? The securities companies, like almost all of their activities are market driven. And as the market goes up, the companies who relies a lot on trading, margin lending, or even brokerage would still see improvement in earnings. So I say partially yes, but also it depends on the other side of the equation is on the internal the company itself. For example, company funding profile, or the company's like all the risk appetite, right? So company, when we assess earning, we don't necessarily just assess whether it's positive or negative, or how large the earning is. We assess the quality of the earnings. From a CRA perspective, we look at whether the income of the earning is stable enough, whether it comes from fee income or margin lending income, which we assess is more stable comparing to trading income. But even within trading income, you have to look at the portfolio, what they're investing in. Lots of companies, when we run the model, their stock holding is performing like similar to the market. So not necessarily investing or trading is risky. That's also one misconception I would like to clear up. But it depends on the appetite of the company also. So yeah, I mean, I'll say yes. We'll see a lot of the credit profile of the companies, the securities company we're covering will be improved, but not going to be all of them. That's going to be depends on the company itself also.
Yeah. Thank you for your view. Another question on market trend, Mr. Khang Lê. Will Vietnam be upgraded to an emerging market after KRX system installed?
Okay, thanks for the questions. I think it's a positive sign. Of course, there are so many factors to decide this. And actually, we focus more on the capital market rather than the equity markets. But to some extent, we see the similar of recently launching the exchange for trading private bonds. So we believe it really good fundamental changes. When this kind of infrastructure development is improved and inflects, that will make the efficiency is increased in the market, and certainly have impacts to support the upgrade on, let's say, sovereign rating of Vietnam. So it's the same with equity markets, like the question. So from our observations, right now, when borrowing from offshore funds, a corporate in Vietnam usually have to bear like additional 1 or up to 2% compared to your regional peers who have the same credit profile, credit qualities, earning qualities. So I think hopefully for the next 2 years, the upgrades will be happen for both markets. Yeah.
I think for the next 2 years, we have a question on a lot of numbers here. Why 27% default ratio did not trigger systematic risk in Vietnam economy, especially considering a lot of bonds are held by retail investor. What mitigated the risk?
The answer is not trigger the systemic risk in Vietnam because, like I said before, Vietnam is a banking-based economy. So, according to our statistic, the outstanding non-bank bond only account for like less than 3%. Exactly, is 2.09% of the outstanding credits at the banks. So the bank is much more resilient in the last 5 years. They accumulate good earnings, better NIMs, and a lot of banks who have reserve coverage more than 300%. So it varies by banks. The exposure, it depends on risk appetite of banks. So we do not see it can trigger the systemic risk for the banking system. For the story of a retailer who holding the bonds, I think supporting measures has been promulgated by regulators, part of governments, to allow banks to repurchase bonds that being distributed by the banks. So I think it shifts the position of who handles the bad debts to the banks. We have, I think, more capacity to handle those kinds of situations. So those combined, we believe that the situation is under control, and then it will be the way out in 2024, and things getting more visible.
One more thing to add. From our estimation, the retail investor only contribute like 30% of the current bond outstanding. It means that the 70%, the rest is held by financial institution.
Yeah.
And I think those are professional investor, and they'll have like measures to cope with the situation of default in the bond market right now.
Thank you for your comments. Mr. Huang, would you like to answer the question on the numbers? For the page 5, figure 5.
Figure 5.
Next slide.
Yes. For the page 5, figure 5, bond default ratio over non-bank bond outstanding. It shows 26.9 default ratio for non-bank bond outstanding. On the other hand, on the figure 7, bond default ratio by sector at 30 June 2023, the highest default ratio by sector is 24.4 for real estate. None of sector has higher default ratio than 26.9%. I want to know the reason for this.
So basically the question is about the default ratio by sector and the overall bond default ratio, right?
Yeah.
Okay. So firstly, our definition of default is including both the late payment bond and also the restructure bond. It means that even though the bond issuers does not announce that they have a late payment, but if they announce that they extended the deadline for the debt. Let's say for 2 years, we treated it as a default. Secondly, I think this is a little bit too small in the notes, but if you read carefully at the formula for the bond default ratio by sector, it say that it is calculated as the value of the corporate bonds with late payment over the total outstanding coupon of each sector. So and the size of the circle represent the scale of the outstanding corporate bonds respectively. So I think we have updated this by announcement from the HNX Hanoi Stock Exchange and calculate this number. So if you want more detail data, you can contact us for like the exact issue number on default data.
Okay, thank you, Mr. Wang. A question on regulation. Could you please comment about whether local bonds must have local rating from 1st January 2024 for the bonds itself or rating for the whole company in general? Thanks.
Short answer is, if you're asking if I want it, short answer is yes. So basically, bond market, capital market, specifically bond market of Vietnam is kind of 95% resembles the structure of India bond market. 95% of volume is private placements. So in India, regardless of you are going issue private bonds or public offering, you have to be rated. I mean the bonds, the issues. So that help the market to have more information on the issuer and also the structure of the deals, and investor will have more information to decide whether or not to invest into the bonds, and that really help the market to improve the efficiencies. So that bottleneck we've been observing for about 2 years. Investors are driven by interest rate offered by the issuer, not the credit qualities of the issuer. So that bottleneck needs to be solved in 2024, and hopefully with improvement in terms of market sentiments, institutional investor and creditors, we are looking for the details of credit quality of issuer to define a lot of things related to the issuance. Let's say the interest rate, the conditions, instead based on the collaterals. Yeah.
Can I add one more point to this? So obviously we are not the most objective party to comment on this, but if I'm allowed to say, I think the requirement for credit rating is quite necessary for even when you look at for banking sector, right? Right now, the commercial banks, they are calculating the risk weighted for lending now based on the industry, which is basically all the borrower, the company have good or bad credit quality would be weighted the same because they fall under the same industry, right? So when there is when credit ratings go into effect, then hopefully that will be be utilized in calculating the risk weighted for the lending, which means that would help the companies a lot. Like the company would, with good credit quality, would be able to be borrowed without suffering the weighted the risk weighted thing is very high. What is it? Coefficient is very, very high right now. Let's say even for securities company, they're getting the because they are in the industry that is say that is categorized as higher risk, right? So they are facing higher risk weighted coefficient. So which means that would affect the amount that they can borrow from the banks.
Right.
But let's say when credit rating come into effect, then the company, between securities company with good credit rating would be able to be both. Yeah, so that would be also be similar to the practice internationally. So that's what we hope that would be taking effect. Yeah.
Thank you, Chairman. We have a very technical question on coal-fired power plants.
Coal-fired power plant.
Yes. Recently, some of the coal-fired power plants investors in Vietnam are requested to come up with transition plan toward green resources. In order to that, these investors need to look into international financing like green bond, blended finance, philanthropy, additional cash flow. However, international investment banking is not willing to finance this project across Southeast Asia due to strong commitment in terms of coal phase out. What is your view on this, and is this applicable? Which technology is the most attractive in terms of NPV and LOCE for these type of investors?
So very technical question in terms of energy sector, right? So the question basically is about if a coal power plant want to transit into green resource, what kind of financing source they can seek out for. So I think this is a part of the bigger plan from the government. If you read carefully in the PDPS, it sets out the plan or the target of the government to reach net zero carbon in 2040 or 41. So by that, they are very limited in developing new coal power plant. So that means that the old coal power plant will have to transit in some kind of form of green resource. The question right now is how they can achieve that and what kind of financing source they can seek out for. So in my opinion, they can seek out for commercial bank domestically because like other credit instrument, I think the terms and the condition is mostly based on the risk and the return, but not more on the ESG factors. But if those plan is too big, I think the problem got bigger, right? Because you need more money, and if you want to seek for foreign money, I think they'll have to specify the really technical thing that needs to be qualified as green. Because if you transfer a coal power plant to a green resource, it is a good thing, right? And if you can prove that to the financials, I think there will be a financing source for those projects.
I think it would be more suitable if I address this question to our head of green financing, Mr. Nguyễn Tùng Anh, and then answer for you in written by email. So please leave us your email so that we can transfer later. So you can see Mr. Nguyễn Tùng Anh we also have a service on green framework verification, and we are also signed a MOU with GGI to build green framework for companies. So it would be for another session or another consultation with Mr. Nguyễn Tùng Anh. Thank you for your question. Last question. Mr. Khang Lê. The individual corporate bond market has been operational for 2 weeks, but there's no significant sign of market movement. Could this lack of activity lead to hesitancy among investors and result in a lack of confidence in the market? how can this market reinvigorate and foster further growth?
It takes time to the market confidence to be restored. So it's just launched for 2 weeks. So let's say we have to wait a little bit more terms that the investor are going to exchange, using the exchange more frequently. So we believe that it's going to be improved in the next 12 months when the situation is unwind. And right now, there's a lot of uncertainty regarding to the transaction in the new exchange. So I think the volume is not impressive, but this is a start. So I believe the confidence can be restored in early of 2024 when the rating will be resumed for the issuance of the bond with certain conditions. So with more information embedded into the profiles, the investor are willing to perform the transaction in the exchange. So hopefully, yeah.
So for this, we also want to send a message for the financial market as a whole that as the credit market is still in the development phase, and we did make mistake. However, we remember that we could not repeat it again, and we will do our best, not from just our government, but also from our credit rating agency and you all investor and local market participant for a more transparent market and to protect the right of retail investor and institutional investor. So for the rest of the Q&A, I will send to our speaker and address this after by email for you all. I would like to sum up the presentation. So as a credit rating agency, we have been produced a lot of ready action for the companies. Recently, we have released a credit rating report on GIG, a renewable energy companies with a category, and Kotekons with a BBB stable. So you can access this report on our website finratings.vn. We also provide investor with credit assessment report, and with this, you can download our sample about a commercial bank for your reference. So a bit introduction about who we are. As FinRating is a company, is a subsidiaries of Group, and we also have four business unit. This is live from financial information with FinPro platform for equity trading. Business formation for trade finance with a FinGate platform. We also have an arm for research and consulting. And for FinRatings, we provide issue credit rating for companies, credit assessment for investor, credit due diligence, and also a lot of green finance service who can provide you some consultation for green framework, green verification, sustainable linked loan. So please give us, drop us an email on support.finratings.vn.com if you want to receive more information. So thank you, our speaker, and thank you, investor and market participant that has stayed with us until the end. So I see you in the next event. Thank you all.
Right. Thank you.